as well, eminent panelists, and we're going to talk about everything to do with the cash flow. We've also had session on the whole bit about how the companies are sort of bringing themselves forward after this whole COVID thing, how they're rescuing themselves in terms of finances. Let's find that out from our speakers. First up, we have Ashwin Bishnoi, who's partner with Khaitan and Co. And he, in fact, prior to joining the firm, also worked at Khaitan, Apps, Slate, Mega, and Flom LLP for 4 years. He's a leading lawyer in the field of corporate law. We also have with us David Chu, who's partner and founder with DHC Capital, who comes with more than 23 years of experience in restructuring, turnaround, and special situations, having worked as an advisor with Ernst & Young and Arthur Andersen as well. We are also joined by Amitabh D'Souza, director AlixPartners, and he partners with clients who are seeking to preserve value and manage their exposure during period of change. So absolutely pertinent to the topic that we are discussing. We also have with us Nitin Jain, partner with EY, and he's a chartered accountant by profession, but brings with him more than 14 years of best-in-class experience in the field of mergers and acquisitions, restructuring and stressed asset management services, and assurance advisory services. Now, the one person who will be extracting perspectives from all these speakers would be our session moderator, Smitha Menon, who's partner with WongPartnership LLP. And she, in fact, is a partner in the firm's international arbitration, restructuring and insolvency and special situations advisory practices. So yes, indeed, we have Smitha joining us, who will be spearheading this fabulous panel discussion for all of you. It's time to bring on board all of our speakers on the main screen. Smitha, being the moderator, has already joined us in. Amitabh has also joined us in. We're going to quickly get the rest of the speakers one after the other. We love how we do it in a physical show. One speaker after the other comes on the main stage. It's a similar pattern over here. I believe only Nitin needs to join us on the main screen, and here he is. So with that, we're about to get our next panel discussion started. Delegates, please do use the discussion button on your right side in order to share your questions with the panelists. With that, I'll hand over the proceedings to Smitha. Over to you then.
Thank you, Kavya. Hello, everybody. My name is Smitha. I'm from WongPartnership in Singapore. And I believe Kavya has already introduced my esteemed panelists. Essentially, what we wanted to talk about for the next 45 minutes is cash, right? Cash is king. And especially now when there's so many companies in distress and a lot of economies facing distress, cash is really oxygen to all these companies. So we all know this. We all know that we need money. But how exactly do we get money? And how financing can be raised for companies in distress is a very thorny issue that there's no clear answer to, and there's no one way of doing it. So let's start with India. Ashwin, if you could just kick it off by telling us, how easy is it for Indian companies to raise financing when they're already in default or they know they're approaching insolvency?
Hey, thank you, Smitha. Pleasure to be on this panel. Good morning, good afternoon. Hello, everybody. It's a very topical question, one that several of our clients are grappling with on a daily basis, and probably have been for a while now. So I'd like to split that question into two parts. So one is obviously when you're in insolvency, and the other is when you are pre-insolvency or approaching distress. And it's sort of more relevant when you're pre-insolvency or approaching distress. And so there is no obvious bar under Indian regulations for a borrower or lender to provide such capital. But the real question is, what happens when things go south? How are you to be treated? And so on and so forth. And the real gating issue, if you will, from public sector banks' perspective, who are the largest lenders in India, is how's that loan going to be treated if you're lending to a borrower already in distress. And quite often those loans get characterized as non-performing assets themselves, which is a clear and present discouragement for banks. So the recent circular that the government of India released in light of COVID, for those borrowers who were not in distress outside of COVID, so they're in distress because of COVID, there is a relaxation provided on this very important issue of whether that loan, the last mile financing or the rescue financing, if you will not be treated as non-performing. So that's a clear indicator and moniker from the government to provide this last mile financing. Have we seen many of these transactions happen under that COVID circular? Not yet, but I think the murmurings have certainly started. The second thing is, I would say, a lot of borrowers in such situation, a lot of public sector banks in India are still reluctant to enter into this phase. So the natural constituents are private credit institutions, Singapore, Hong Kong, London, New York-based funds, for whom none of this NPL classification taint is an issue. And so a lot of capital has come into India from those accounts. Those are necessarily much higher IRR accounts. And the only catch that I would end by is question is whether those loans, if they are treated super priority pre-insolvency, whether that super priority continues in insolvency. And I think Indian regulations don't really permit that. And there is a movement to amend the insolvency law to allow for that super priority treatment. One such amendment has happened where the government's real estate fund, if it provides last mile financing to pre-distressed real estate borrowers prior to insolvency, that is treated as super priority even in insolvency. And so I would only hope that that is taken to its logical conclusion and made available to even private credit institutions.
Thanks, Ashwin. So it's not, it's quite similar in Singapore, except that we've codified the priority, the super priority aspect of it. So before COVID-19 hit, our legislation had actually put in some new provisions whereby to entice banks and to entice financiers to come and lend to insolvent companies, even though there's, no assets or it's a credit risk, to sort of make it worth their while. But it's still very new, and we've had a few cases, but essentially the main problem we have is Singapore being a financial center. We also have to observe the bargain that's been struck with the banks. So any sort of rescue financing or super priority must take into account the bank's interests. And usually for us, the way it works is, or the thinking is, if there is an equity cushion, that's one way to make use of the rescue financing provision. So if you have an asset and the asset is worth more than the loan, then there is a bit of an equity cushion, but banks and mortgagees or chargees don't like to give up or allow a second charge or a second mortgage. So this sort of forces them to do so. That's the kind of legislation we have. The other sort of super priority we have in Singapore is really more for in a liquidation for you to have priority over other unsecured creditors. So this is the sort of gamut of super priority that we have in Singapore. The ultimate one of actually breaking into a secured creditor security. We have that in the books, but it hasn't been tried yet. And I think only a very robust case would actually be able to show how that provision works. If I could turn to Nitin. Nitin, now that we've heard from Ashwin how that apart from the COVID-19 relaxation measures, there is generally in the IBC no specific or targeted rescue financing legislation. What is it that Indian companies typically do in reality, in practice, to get cash? Is it common for them to turn to the promoters as the main source of funding?
So I think I would, to answer this question, I'll just go back to what Ashwin stated earlier and what you touched upon. In India, to understand the rescue financing, we need to just go back a little, in history, what has happened in recent past. So before, I would say IBC and post IBC, right? So before IBC came into being, I think the rescue financing was primarily being funded by the banking institutions, existing banks themselves, or by the sponsors, either through equity or by raising money through pledge of equity from NBFCs, which were thriving at that point in time. And obviously, we have seen a significant amount of NBFC crisis. So that is one window which has got closed for raising money. And then post IBC. So post IBC, as you rightly said, and Ashwin also pointed out, there are challenges in terms of raising the rescue finance, and the sources are similar. It could be the banking institutions, it could be the stress funds which Ashwin spoke about, or NBFCs. But the biggest problem which people or the company faces in raising rescue financing is getting a priority status and charge on the security, because the existing lenders doesn't want to release the charge because the new financer would definitely want a first priority charge or a super charge on the asset. But even then, if if in some cases, if the lenders allow that to happen, whether that will hold the ground in IBC or not is a question which, is a $1 million question which nobody has the answer. So that is why people want exclusive charge so that they can hold their ground even in IBC situations. Then moving on to situations pre-restructuring and post-restructuring. So just to add to what Ashwin stated, even earlier, before the COVID circular came into being, which is the recent circular, the existing circular which was there for the restructuring, which is the popularly known as the 7th June circular, as part of that circular, there is a provision for additional funding to be allowed, and that will not be classified as substandard or a NPA, right? While any restructuring will result into a classification of an account as an NPA, but as part of the restructuring, if new funding is provided by the same set of lenders or a new lender, that will not be classified as NPA. So that provision is already there in the regulation, issued by RBI. The problem is the commercial negotiations, commercial understanding, and agreement for a priority status both on the cash flows as well as on the security, unless the sponsors bringing some exclusive or additional security from outside the pool of assets or the securities which are already there, or they bring in some equity. But yes, depending on a situation to situation and a case basis, we have seen all kind of coming in, both in the form of equity, in the form of existing lenders supporting the company, or new lenders like distressed funds or NBFCs coming into the system. But that will be very, very specific to a situation.
Thanks, Nitin. So we take a step back and assume, because I think something Ashwin said earlier was very important. It's important to draw. The IBC does make a big difference. I mean, you look at post IBC, the issue really is if once your company goes insolvent, there's less incentive for the promoter to want to lend, right? Because it's a very creditor-driven or bank-driven process. So the best time to get the promoter to put in money is even before the banks start, applying for it to come under an NCLT process. So what it is that banks look for, or what is it that's in the balance sheet that would be attractive to financiers? Can I ask you, David, as an advisor, a financial advisor, what would you look for in a company's balance sheet or its finances to decide if there's a proposal you can put to a new lender?
Sure. Hi, Smitha. Thanks. There's a number of key factors that I think distressed investors would look for. First one would be there needs to be a viable business post the restructuring. So they need to understand what went wrong, the business plan, the path to profitability. The second one I think they would look at is the capital structure, what the debt stack looks like, bonds, bank debt, what's the security structure in terms of assets. The third step is the management team, the quality of the team and whether or not they want to put in their own team with hand-picked appointees. And if you look at a case in Australia, a company called Virgin Australia, which is going through a distressed sale through a voluntary administration process, the new owners, which is a private equity firm called Bain Capital, have very publicly now just changed CEO. So that's something they would definitely look at. There would also be an industry analysis where the company is positioned in the industry. And I think looking into that a bit more deeply is the company even relevant? Does it need to be around? Does it have real IP? Does it have a brand? Does it have a product? Is there synergies with the buyer? As an example of that, we were recently involved in the distressed sale of a company called iFlix, which is a streaming company. We sold that to Tencent, the Chinese tech giant. And Tencent was looking at it from a proprietary content, tech platform, customer user base perspective, and that's where they saw the value in the company. Going on to the next point, it'd be valuation. What's the going concern value, the liquidation value? And then looking at the last 2 points, you probably have to look at where the entry point is. So should they come in as a secondary buyer of debt, looking for the fulcrum security, potentially as a loan-to-own strategy? Do they want to buy it outright? Is it a distressed M&A deal? Do they want to come in as a white knight investor on the equity on the back of insolvency and then try and buy it out of insolvency? And then in structuring around that, what sort of downside protection they would be looking at. So some form of security, whether it's a super priority through the courts, like you mentioned in Singapore, or whether it's through other available assets that the company may have.
You mentioned fulcrum security. Could you elaborate on that a little?
Well, it's the part of the capital structure that is likely to be impaired by the restructuring. So it is that element of the capital structure that is likely to be converted into equity, say. So it is generally it would sit probably in the senior debt, depending on where the assets are, or maybe in some sort of bonds type level. But it depends on the value of the assets and what is the enterprise value, and also potentially how the value breaks in terms of the capital structure.
Thanks. So essentially, I mean, it sounds like at a minimum, there has to be something viable in the business, whether it's IP or something. There's got to be something there for it to even get off the ground, right? So if I could turn to Amitabh, let's say we've established that this business has got great potential, it's got growth potential, there's something there, there's something viable. What would the lenders' priorities be when they think about their risk-reward matrix before they extend lending?
Thank you, Smitha. And David, to add to what David has just said, any new money is provided, based on an achievable business plan. So basically, from a lender's point of view, minimizing execution risk against this plan is essential. Prior to extending any sort of new money to in the form of a distress financing or a rescue financing, to a stressed or distressed borrower. So funding is typically provided against a stress-tested business plan. There's reporting requirements to stakeholders. Prior to any further drawdowns are allowed. In most of these cases, the credit documents will require that some kind of reporting is required from the party who's independent. So temporarily advisors are hired or contractors are hired who would report directly to the stakeholder, not necessarily with the management, but alongside the management. In general, rescue financing providers, they want to see alignment of interest between key stakeholders. So they want to see an equity owner who may be presently out of the money, but is willing to invest in the process in order to, preserve control and get his or her equity, restore that equity value and get it in the money. So these are sort of the key things that a rescue financing provider would look at in terms of the risk.
Certainly, we've seen that with Asian companies, at least definitely in Singapore, the banks do want to see that the promoters have skin in the game. I mean, they especially for a lot of Asian companies, the promoters or the main majority shareholders or the significant shareholders are the people who are instrumental in building up the company and have the connections. So we see what we see that is very common here is when you ask banks to lend, they'll want to know that you yourself are invested and you've got your own personal skin in the game.
Yeah, so, they want to see some kind of, that the pain among the stakeholders is being shared. So someone who's investing in the process, they want to see an operational plan where, there are cost reduction opportunities. It may not be new money, but it certainly shows that this stakeholder to stay in the game is willing to invest in the process. So that sort of alignment is very important.
Well, some cynical banks have said that, hey, the stakeholders have taken so much out of the company before, it's only fair they put some back in if they want us to come and help save it. So it's two sides of the same coin.
Every new money decision, it starts at that point of time. There's no point looking back.
No, that's true. So, okay, when it comes to turning to existing lenders as the source of new funding, could you just a bit more, Amitabh, on the types of situations where you think banks may be willing to lend?
Yeah, I mean, one really common example is where putting in new money actually improves the prospects of recoveries on the old money. So putting in new money for a certain period of time in order to allow for an accelerated M&A process so that a buyer can do a due diligence actually improves the overall prospects of recoveries for all the lenders, including the new money lender who's generally already in the current sort of capital stack. Basically, in this situation, if that entity would have gone into liquidation, there would have been overall lower recoveries. So it always makes sense to put a little bit more in order to extend the runway so that a buyer can do a due diligence. Basically, in this scenario, a liquidation is avoided and it improves the recovery process for everyone.
So let me turn to Ashwin and Nitin and ask them this, because under the IBC process, the banks really have controlled the restructuring. So if you have a company that's undergoing an NCLT process and the banks are looking at what to do with this company, what the proposal is for this company, would they would this be their mentality, what Amitabh just said, which is, look, it's not throwing good money after bad, because by lending, I'm actually enabling the company to pay myself back? Or are the banks in India generally not so forgiving? And I know Amitabh said draw a line in the past, but are they, when they're administering, when they're looking at a company undergoing an NCLT process, is their mindset, okay, enforcement or just a managed sort of liquidation? I'm grateful for either of your views or both of your views of this, what you've seen.
Ashwin?
Sure, Nitin. It's a hard question for the Indian scenario because, as you know, India does not have a debtor in possession model. In fact, I read somewhere, interestingly, that the size of the Indian economy is similar to what was the size of the American economy in the 1980s. Now, I don't know if that's true, but it's in the 1980s that America really rebooted its insolvency law and went towards a debtor in possession model. But India has chosen to go with a creditor in possession model. And not just that, we don't allow connected parties to bid. So our IBC law is effectively designed for M&A from third parties. Now, in that context, the way the moral hazard has fallen is quite interesting. So clearly, in insolvency, there is very limited, if at all, no scope for the promoter to provide any capital. Why should he or she, when there isn't any scope for the promoter to actually get the company back? But pre-insolvency, it has resulted in an interesting moral hazard scenario where till now, India was a very much extend and pretend regime. That time has quite clearly gone. So with the various dirty dozen situations where promoters have lost control of their companies, it is a very real and viable threat now that if there is a default, the promoter will lose control of this company. And so if the promoter can provide that last mile financing, which will revive the company, make it better, and able to service its debt, then I think promoters are looking at those situations today. The problem is whether they have the liquidity.
Nitin, anything you want to add?
No, absolutely. So absolutely, to add on to just what Ashwin said. So even prior to IBC, promoters were looking to provide funding, and they used to provide funding. And if you see some of the situations in past which has happened, a large number of groups which have failed actually have gone down because of one company not doing well, and promoters continue to provide support, taking out or dipping into the cash flows of other companies, and that other company also went bankrupt because of that. So that's been the case, and that's been quite prevalent in India. Number one. Number two, I think, as Ashwini said, the fear of losing the company because of IBC has definitely resulted into sponsors providing support to companies where they feel that the company has a bright future, or the revival is or the problems are temporary. It can result in future cash flow. But where the companies have lost the business potential, then obviously the promoters or sponsors are also not willing to put more money. As far as the existing lenders concerned, Smitha, your question is, in NCLT, especially with large number of public sector banks participating into the as part of the existing bank lending group, there is very limited scope or situations where we have seen that existing banks providing the rescue funding as part of the NCLT processes. But what Amitabh said is absolutely true in situations where, pre-IBC, where they feel that the company has a revival potential and there is value to be made into that company. Not only in M&A situations, yes, M&A situations have been case in point as examples where people have provided or banks have provided funding to sail through a temporary period for a exit after that. But even in situations where you need last mile capex funding, where the capex significant amount of capex has already been done, but you are not able to bring in the last mile equity to complete the projects. Lenders have got into the control and taken things into their hand, provided that last mile funding, completed the projects, and have resulted into either in good cash flow or maybe they have exited. And there's a very recent example, a very large power project which was funded by the largest PSU bank, along with other state banks. So the PSU bank itself took over on it and provided that funding to complete the project, and then they got out of the project. So depending on a case to case and situation basis, these things are prevalent, but there is definitely a change in mindset from the promoter side because of the fear of losing their company under IBC.
So is it still the case in India that the promoters can't bid for the assets once they are sold in an enforcement sale? Or do they find ways to do so?
No, I think it's very hard. I'm not aware of. I'm sure people might be trying. Try till you succeed, but it seems very hard to do. The only way, I think the IBC tries to balance promoter interests by allowing them to settle bilaterally with creditors and then withdraw from the insolvency process, in which case the benefits of the insolvency process, there are a few, are not available. And one hears of several instances where promoters are trying to do that, but not aware of any one of the larger cases where that has been successfully implemented. But in a liquidation sale, no, very hard to do.
No, I understand. So I see what you mean by wanting to balance the interest. I guess where I have some confusion over this is money is still green, right? Even whether it comes from the promoters. So why are the banks? What's the policy thinking behind preventing the promoters from participating? I mean, as long as it's the highest price and no one else outbids them, it's a public process, isn't it? So does it matter that the money came from the promoters as opposed to, arm's length bidder?
Do you want to take that, Nitin? I think Nitin's probably having an internet issue. So I'm happy to chime in there, Smitha. I think it's a tough policy decision that the government had to take. No different from what I think the US took under its, the railroads insolvency laws when they first came about. I think the thinking there is that in India, there is an information asymmetry, that the promoter has better information than third-party bidders. And if one were to allow the promoters to acquire the companies, then it would make price discovery not so transparent. Secondly, I think someone very famously said to me that every religion needs a hell. So every insolvency regime needs consequences. And unfortunately, maybe the policymakers felt that this consequence was needed. There needed to be a hell for the pre-IBC restructuring regimes to work and creditor payments be respected.
Thank you. Here in Asia, what's the landscape like there?
if we look at Singapore and Southeast Asia first, I think there's two distinct segments. The first one is the companies that were facing liquidity pressures before COVID, and COVID just accelerated the timeline. So I think in Singapore, we're seeing a lot of debtor-led rescues, shipping companies, construction, oil and gas, where the companies are identifying a white knight investor to inject some new funds, possibly on the back of a restructure, usually say by a scheme of arrangement. If liquidity is tighter, then they're filing applications in court, making an application for the moratorium and trying to use some dip financing to get some breathing space and then to put together a plan and fund operations. So we've been involved in the 3 successful super priority cases in Singapore, and 2 of those were used by white knight investors to in effect control the process and then embed themselves in, get information, and then ultimately try and do a deal. And then the most recent case involved a pre-petition roll-up, as Smitha had mentioned earlier. I think the second segment is more for companies that have been more impacted by COVID, and then we're seeing some secondary debt activity where banks are exiting because they now have a better understanding of the commercial viability of borrowers. They've had an understanding now of the sponsor's behavior and what the recovery would look like, and then potentially they're seeking to exit out and then get some new capital to come in. And that's where the private capital, alternative capital, I think is ready to fill the gap, whether that is in some form of primary opportunity or a secondary deal, because they have the ability to provide tailored solutions with some speed, which I think is important for this market. Just to quickly touch on Australia, I think primarily we're seeing rescue financing there coming out of insolvency, in particular the VA process in Australia. So you're seeing that in hard-hit sectors like retail, airlines, Virgin Australia, Bain Capital is probably the biggest one. There's been some stationary retail companies, KKK and C4E, which have been taken over as well. There's a whole bunch of retail, Jeans West, Colette. They're all in some form of trouble. So, they're looking to use the VA process to get out of some bad leases, reduce the costs, close some stores, and then allow a new investor to come in with in effect, a cleaner balance sheet or a cleaner capital structure for them to then continue on from there.
Thanks. We have a question, and I think I'll direct it to Ashwin. The question is, can the COC, which I assume is the creditors committee or the committee of creditors, can a COC, by a resolution, force the existing creditors to provide interim finance?
So, no, I don't think they can force a lender to provide interim finance. Any interim finance in India needs to go through the COC. And I think the question is coming from how things work in the US, where there is a possibility of priming loans, but there is no such mechanism under Indian law. I mean, you've got to understand the background in which the Insolvency and Bankruptcy Code was drafted. It was not drafted in an environment where businesses fail and businesses succeed. Yes, that is part of the history of the IBC, but it was drafted in a scenario where public sector banks in India were extremely stretched. So a lot of the concepts in the insolvency would not put banks at further risk than they already are. So I don't think there is a mechanism within the IBC for the Committee of Creditors to force a lending. But of course, they can agree to take super priority loan and seek judge.
See, no, that does make sense. I think it would turn the financial institutions on their head if they knew that they could be compelled to, expose themselves to further credit exposure if they didn't absolutely want to. So, David mentioned roll-up financing. That's something that's a very recent thing for us in Singapore. We had a case whereby the only way the lender would lend was because the deal provided for the lending to partially repay the lender's own loan. So in effect, you're greening your debt. And the reason why it was attractive to the bank to do so was because the bank was the sole secured creditor. And it was a construction company. And what it needed was not cash facility, but more of performance bond facilities to be able to, because all these bonds were coming up for renewal, and you need to have the bonds renewed for the project to continue. And from the bank's perspective, they felt that it made more sense to lend in order to then pay off the old bonds and renew and issue new bonds under this, while the company is undergoing a restructuring process, because it was under a moratorium protection. It's a bit more recent. There's priority because it's seen as, debt incurred during the restructuring. So that was the incentive for us in Singapore for banks to do what we call roll-up financing. But it's only been one case, and it was a very gentle sort of attempt. We made sure that the roll-up financing still provided new money. I think that was an absolute minimum. You need to provide some new money. You can't just lend to just pay yourself back. But a chunk of it did go to paying back the bank. So the bank can at least report internally that it's cleaned up some of its old debt, and this is like new lending to a company who's undergoing a restructuring and can trade out of its difficulty, because by extending the performance bonds, it can continue to take on new projects and perform existing projects. Is a structure like that something that you think Indian banks and Indian companies would explore, or is there just no mechanism or interest? I'm seeing skepticism on your faces, so I'm guessing it's not something that is viewed as legitimate.
So it depends, Smitha. Actually, currently the banking sector in India is dominated by the public sector banks, right? Private sector banks are very, very limited, and obviously the share in the market of private sector banks is increasing by the day. But as we speak, the majority of the lending has been done by the public sector banks. And also to the previous question which you raised, Ashwin answered that why IBC did not allow the sponsors to participate these sponsors, right? So I think it's more to do with the sentiment and the thought process with which the public sector banks work. It's more of a fiduciary responsibility they have to manage the public money. So taking any such action or decision, or thinking everything on a commercial basis seems to be slightly an issue if it is not seen appropriate in the light of law, etc. So I think there is a skepticism among the lenders to take such calls or bold calls, structurally, while it is possible, but as we speak today, it's really difficult, or we have not seen such cases being taking place.
Smitha, you're on mute.
Yes. Okay. Yes, sorry. Thank you. I was going to say we have one more question, and I'll open it to whoever wants to answer it. The question is this: if the priority of rescue lending is allowed, then there is more money available than what is required from the existing. Okay, I think I agree with this. If the priority of rescue lending is allowed, then there is more money available than what is required from existing creditors. How would the question of whose money to accept be decided, as this is prejudicial to those lenders whose money is not accepted? Okay, if I repackage the question, I think what the question is saying is, if you've got a lot of offers to lend, how do you decide which to choose? I believe, unless someone else has a different take of it. It's in the discussion.
Well,
yes. So
I would just quickly add that whoever has asked the question should reach out to Amitabh, David, Nitin, and myself, because there are very few instances where we have multiple bidders for rescue financing in India. So more from area.
Yeah.
Well, I suppose
not in India, but internationally, sort of, especially in the US, right? Typically, the default. Not typically. I mean, the default rate on DIP financing loans is very, very low. There are very few cases. So there is actually a competitive market for DIP lenders to lend, because your default rates are low and your pricing, your margins are high. So there are certain markets where people are fighting to lend.
Yeah.
I think he's having a bit of technical issues. No, I think you're right. And I guess my answer to that would be whoever offered the best terms, right? Because some of the terms are really quite cutthroat. It's just another form of strangling the business. I mean, you may get like a quick in and out, but you're left with a tail that makes it very impossible to keep going. Okay, any final thoughts from the panelists? Because I think we've run out of time. Any comments, David, you want to add to round off?
No, I think we've covered it pretty well. So yeah, nothing from me.
Okay, all right. Amitabh, Ashwin, Nitin, any parting words? If not, I'll hand the floor back to Kavya.
So only one comment. I think in India we are still seeing this concept of rescue finance as a new concept, and we are developing this market. I think things are changing rapidly over the last few years. The banks have started seeing or accepting this as a concept. Earlier, this was not something which banks or lenders were familiar with, but I think this is becoming more and more prevalent, and people have started accepting it. So we'll see much mature market positions going forward is what I feel.
No, that does make sense. Well, thank you, everyone. Kavya, I'm going to hand the mic back to you.
Thank you. Thank you so much, Smitha. Despite the tech disturbances here and there, you beautifully moderated the session. We managed to get some amazing insights from all of our speakers. So thank you so much, gentlemen, for joining us. Thank you, Smitha, for joining us. And thank you for taking those questions from our delegates as well. And with that, now I'm going to be requesting you to click the exit panel button so that all of you can proceed backstage, and in case you want to carry forward your conversation there. Yeah, but thank you so much for joining us at the Insolvency Summit. Thank you once again.